Welcome back to Morning Trade Live. It's time to go inside out on Cava ahead of the quarterly report. Caleb Silver, an editor-in-chief of Investopedia, is with me, and we want to take a look at what folks may be expecting from Cava. And ironically, we did just hear from Sweetgreen. They talked about cutting back on pricey salads. The customers didn't want to pay for those. Chicken has been hot lately. I mean, what do you think we might want to look for here?
Well, don't forget that Cava actually raised its earnings guidance back in May. It had a terrible miss back in mid-February. The stock got nailed 20-25%. But back in May, they actually said things might be a little bit better. Don't forget also that Cava does a lot of local sourcing for its produce, so it's not necessarily dependent on tomatoes from Mexico, even though those just got a baseline new number from Mexico. So they do a lot of local sourcing. They had pulled back a little bit on the amount of restaurants that they might open. They raised that forecast too. So the guidance looks pretty good, especially on the revenue side where we're looking for 20+% growth.
You know, considering how resilient Chipotle has been, and Chipotle and Cava are different, I understand, but they're similar. I mean, they both have that Mediterranean protein and vegetables type of vibe. So, you know, Cava came on and took off, but it hasn't been a particularly good stock. This went from 172 last winter down to 70 in the Liberation Day sell-off, and it's only at 83. It hasn't really recovered much.
Yeah, and it's still got a pretty high PE ratio when you think about the company and its sales, 69 on a fast casual restaurant. If you're an investor, you got to wonder, is that a little too highly valued? Now you think about the footprint of Cava. It's sort of the new upstart, even though it's been with us for a few years right now. It doesn't have as many restaurants open as a Starbucks or Shake Shack and others, but it is trying to continue to grow its footprint. Do that at a time where consumers might be thinking very carefully about spending money out. We just got the CPI report this morning. Food away from home, that's fast casual, those are your restaurant visits, up 3.9% year over year. Cava feels like it's kind of insulated in terms of the tariff costs for food costs, but not for wrappers, not for the bins that you put things in when you take them to go. It's got some exposure, but less than a lot of its competitors. And when you look at its competitors, it's fared a little bit better, although the whole sector has been pretty smashed by concerns about tariffs, concerned about spending.
Caleb, check that out. Look, Chipotle, 3,600 U.S. restaurants, Jersey Mike's, 3,000. Panera Bread, 2,200 U.S. restaurants, Cava 360, and Shake Shack 370. I mean, some folks, you think of them almost the same in some ways, but they're so not. The scale, size and scale, it just shows.
Totally different scale.
They could grow. I mean, that gives them penetration ideas. But
the balance for these fast casual restaurants, though, is should we open more restaurants because they can recognize the revenue almost immediately, but there's very tight margin costs when you think about what it costs to actually open one versus the real estate, the hiring, the produce, everything that goes into it. So they have to have this balance of how many can we open to sustain revenue growth and continue to grow it, because 20+% revenue growth looks great, but not when your earnings per share keeps sliding because of your costs for opening. It's a tough balance for these companies at a time where spending is in question. Are we going to continue to spend that $20 on that lunch out during the week? And if so, is that going to be a Cava, Chipotle, a Shake Shack? Who's going to get that share of the money?
You know, also, it's just, I was reading one thing here that says Sweetgreen versus Cava, wilted earnings meets Mediterranean muscle. And there has been the whole GLP-1, everybody's looking to protein and vegetables, and maybe Sweetgreen's, this is what this article is saying, that maybe Sweetgreen's loss could be Cava's gain on this August 12th report.
Yeah, could be, and the expectations are high. Again, the company did raise its guidance. When you think about what Sweetgreen just reported, that was not what investors want to hear. They want to hear about revenue growth. They want to hear about restaurant expansion, same-store sales growth. If you're not sustaining those things as a fast casual restaurant where the margins are razor thin, you are not going to make it. And investors punished the stock again back in February when they missed. We'll see what happens after the bell today. But since the company raised guidance, we've seen a little bit more wind in its sails. Let's see if that can sustain itself through the earnings report this afternoon.
And even a real winner. I mean, I will say also, before I move on to Chipotle, I just wanted to say Cava also has a loyalty program that has been gaining some traction as well. So maybe Cava could surprise us, but these names have been under pressure. Chipotle also has gone from $66 down to a new 52-week low this week, really, 41 $10.
Yeah, so it tells you where investors are sort of placing their bets in this sector right now, and it's not been with Chipotle, which seem to have struggle after struggle, and we don't necessarily know what's going to happen with tariffs with Mexico. We do know that the Mexican government set that baseline for tomato exports at $1.70 per liter of tomatoes. That's good. There won't be any anti-dumping issues potentially in the United States, but what about avocado? Chipotle relies heavily on that, plus protein costs, chicken and beef, those are just going up, continue to go up month after month. So it's facing a difficult time with a pickier customer, pickier consumer, and higher ingredients, plus the fact that it has 3,600 restaurants. It's tough to sustain that same store sales growth when you have that many restaurants and you have all these factors impinging on the company's growth.
Yeah, and Chipotle had same-store sales decline, and they talked about a more cautious consumer, and that confidence had dropped a little bit. And if you look at that jobs report last week, I mean, I know Bureau of Labor Statistics is something we've watched for many years, but it just didn't spill confidence out. So that is something for shoppers, what they will or may not decide to spend on. Final quick thought.
Yeah, watch the ticket orders, right? Watch the size of the order per customer. McDonald's is telling us people are ordering down menu. They're spending less every time they go in.
Value.
We're actually hearing that from Walmart as well. So there's going to be a lot of competition here. How does Cava respond to it? How does Chipotle respond to it? The battle is on for our dollars when it comes to fast casual. But are they going to be giving us discounts and incentives, or are we going to be ordering maybe the $15 item, not the $20 item? That'll make a big difference with same-store sales.
But JP Morgan has an overweight on McDonald's. They have a $3.10 price target. They raised that, and it's at $3.03 today. And McDonald's sales have rebounded. They've been pushing the value message to folks. We got you covered. We have food that's more affordable. Caleb Silver, great to see you, of Investopedia. And now, folks, we want to take a look at the charts and some example trades for you. That's why we bring in Tom White, host of Fast Market, taking a look. How about we first take a look at your example trade for Cava, please, Tom?
Yeah, Nicole, expectations pretty elevated on this one. You got to remember this stock's pulled back about 26% so far this year. It's off over 50% from those all-time highs that we saw in November, above $172 a share. So I think if you take a look at what's going on, and I know we're going to talk Chipotle, but we've seen a lot of these fast casual places start to pull back here a little bit. Option market pricing in a plus or minus about $8.80 move either way. That's about 10%. Either way in the shares going into this report. So implied volatility levels elevated in near-term options. So I looked at something because we have seen this stock pull back a little bit. If you're more bullish on it, we'll use those implied volatility levels or dispersion to create a strategy here if you think this stock's going to rally about that one standard deviation. So I looked at a bullish call diagonal here where I'm going to buy something at the money. And I went out to the August 22nd weekly option. So 10 days to expiration. We're going to buy the 83 strike call in the August 22nd weekly options, and then against it in the near term August 15th monthly options that expire in just 3 days. We're going to sell the 91 strike call. So a bullish $8 wide call vertical to the or call diagonal to the upside. You're going to pay roughly about a $3.50 debit, so less than half the width of this call diagonal. The risk on it is the debit you pay on it. Break even above anything above 85 is going to be profitability, but you can see it from the risk profile at or near that 91 strike is where you get the apex of profitability. And because you paid less than half the width of this 1 week wide call diagonal, anything above that break even is going to be profitability on this one. Now, why does it cost so less for, basically an $8 wide call diagonal is because you're buying about a 96 implied volatility on aggregate in that August 22nd weekly, the 83 strike calls, selling about 150% implied volatility in the near term August 15th options where you're selling the 91 strike on this one. So bullish call diagonal to the upside. If you think it's going to move higher, this takes advantage of that. And it's about the strategy, Nicole. If you're more bearish on this name, you think it's going to fall out of bed like Chipotle did last earnings, then you would do the put diagonal. If you think it's going to fall about that one standard deviation. So, good way to look at this one. And it's based on the strategy, not really the direction. You pick the direction, and it's all about the strategy on this one.
I see. Okay. Well said. So we understand now. What about, you mentioned Chipotle, and what do you think for an example trade for Chipotle at this point?
Yeah, getting a little bit of a pop here today on back of an upgrade in the shares. But if you look at some of their numbers, they saw decreasing sales. We did see some unusual option activity in here yesterday. We talked about it in your afternoon show where there were call buyers in there, and then Piper Sandler upgraded the stock overnight. So the stock's getting a little bit of a pop here. But still, it hit nearly 2-year lows just yesterday, still down about 29% so far this year, but getting a little bit of a pickup. So I looked at a strategy that gives myself some duration. If you think the stock's going to recover from the sell-off that we've seen to nearly 2-year lows, this takes advantage of it while giving myself some duration. I went out to the October monthly option, so about 66 days to expiration on this one. Going to buy the in-the-money 40 strike call. It's got that higher delta. It reacts more like the stock. That's the bullish portion of this trade. Then to offset some of the costs on that bullish call purchase, we're going to sell the 50 strike call. So a bullish $10 wide call vertical in the October option series. You're going to pay roughly about a $370 debit. That's your risk, $370 per spread, and it takes your break even up to $43.70 over the next 2 months. That's less than 2% above the current share price. So you've got duration, and you only need less than a 2% move to get above that break even with the expectations. If you think this thing is going to continue to rally, this takes advantage of it in a lower volatility environment, so it's going to cost you less to put on this bullish call vertical.
All right, Tom White, great to see you. Thanks for those example trades on Cava and also Chipotle. Thank you, Tom. Catch you later. Appreciate it.